Welcome to datascience.show, the podcast where data science meets executive leadership. We talk with top AI and analytics thought leaders about turning data into real business impact. If you're a C-level leader or data expert shaping the future, you're in the right place.
Let me start with a short story. A mid-size insurer deployed an algorithmic pricing engine for commercial auto policies. For months, it undercut competitors and grew market share. One month, a data pipeline change pushed a bias into the model, and the system quoted thousands of policies at materially incorrect premiums. Claims followed, and the carrier faced a multi-million-dollar exposure. They filed for coverage with their reinsurer and were told, "This looks like an operational failure, not an insurable act." The claim was either rejected or paid at a fraction of the business impact. Boards were blindsided. Finance teams scrambled. Executives realized they had large, uninsured tail risk sitting in the product margin. That vignette is not hypothetical. It's the risk many executives are waking up to right now. Why does this matter? Because in AI, surprises are not theoretical. They can hit the balance sheet fast, and they can erode trust with customers and regulators. Today, I'll walk you through a decision-first playbook to convert that latent, uninsured AI risk into priced, auditable instruments you can fund and manage. From models to measurable value, this is about turning operational uncertainty into financial optionality.
Quick framing before we dive in. Treat risk transfer as a strategic lever, not a compliance checkbox. Most boards hear insurance and think of risk avoidance. I want you to think like a CFO and a product leader at once. What residual risks do you want to fund? Which ones do you want to surface to the market? And which ones are better retained on the balance sheet? This shifts the conversation from "can we insure this" to "should we insure this, at what price, and with what controls?" That decision-first lens will guide every subsequent step. First, what counts as a transferable exposure? Not everything an AI system does maps cleanly to insurance, but there are clear categories that underwriters understand: consumer harm from erroneous decisions, direct financial loss tied to algorithmic errors, confidentiality breaches that leak proprietary or personal data, and regulatory fines where statutory liability exists. When you talk to insurers, they want quantification. They want exposure bands. So don't say it could be catastrophic. Say, we estimate annual loss exposure of X to Y for this product line under 3 scenarios: nominal, adverse, tail. Here's the loss frequency and severity distribution. Break exposures into buckets: transactional errors, pricing, settlements, model drift causing systematic mispricing, data leakage incidents, and compliance failures. For each bucket, map the impacted legal entity, the affected customers, and the maximum foreseeable loss you would need to cover. This is not actuarial guesswork. It's an executive inventory exercise. You can start with a single product line and use historical incidents, stress tests, and scenario analysis to generate defensible bands. Insurers price what they can measure. Give them numbers.
Second, underwriting signals you can and should provide. Underwriters are explicit about what comforts them: loss velocity metrics that show how fast incidents propagate, detection and response latency because a slow fix increases ultimate loss, evidence trails, time-stamped logs, model versioning, and decision contracts that show who decided what and when. Concentration metrics showing whether one model, dataset, or third-party vendor creates systemic exposure, and SLO attainment history with portable artifacts that prove SLOs were met before failures. Think in board-readable telemetry. For each signal, design a clear measurement: loss velocity as average number of affected customers within X hours of an incident, detection latency as mean time to detect and mean time to remediate, concentration as percentage of revenue tied to a single model. These become the underwriting inputs. You can even predefine threshold bands, green, amber, red, that map to premium adjustments or trigger parametric payments. The advantage is twofold. Underwriters underwrite faster, and you create governance anchors that improve operational discipline.
Third, what instruments should you consider? There's no single right answer. There's a menu. Traditional liability insurance is familiar: broad cover,
claims adjustment process, but potentially slow and messy if the failure mode is novel. Parametric insurance pays on pre-agreed triggers. Think SLO breach by X% over Y hours with verifiable audit artifacts. Parametrics can be fast and predictable, but only if you and the insurer agree on credible, objective triggers. Performance bonds and surety products are useful when you need contractual assurance from a supplier. They provide capital if performance metrics fail. Escrowed remediation funds, where a portion of contract value is ring-fenced to cover fixes, are simple and often politically easier to arrange. Captive insurance can make sense for large firms willing to retain risk and manage premiums internally. Captives let you smooth costs and create long-term incentives for better engineering controls. When choosing, weigh speed of payout, clarity of triggers, cost, and the vendor or counterparty you're protecting against. For example, use parametrics for quantifiable SLO breaches where telemetry is airtight. Use traditional liability when legal loss definitions and customer harm are the primary concern. Use escrow or performance bonds when procurement and vendor performance are the chief risks.
Fourth, contract and warranty design. This is where procurement, legal, and your insurers must speak the same technical language. Start with clear claim triggers. Tie warranty obligations to observable, time-stamped SLO breaches or forensic evidence, rather than vague language like reasonable efforts. Define proof of harm requirements, what constitutes demonstrable loss, what evidence vendors must supply, and who conducts forensic analysis. Address subrogation and indemnity. If a third party causes the loss, insurers will expect subrogation rights, and vendors will push back. Be explicit about audit and forensic access clauses. The insurer needs timely, read-only access to audit trails and model artifacts, version history, training data lineage, and decision logs. Insist on a dispute resolution ladder. Internal joint fact-finding within X days, independent arbiter within Y days, then claim payment timelines. Draft modular language so you can swap parametric triggers or SLO definitions without renegotiating the whole contract. A short practical clause I recommend. Upon documented SLO breach as defined in Exhibit A, vendor shall 1. Notify within 24 hours, 2. Provide time-stamped evidence specified in Exhibit B, 3. Fund remediation from escrow within 30 days pending independent verification. This makes claim readiness concrete and reduces negotiation friction with insurers.
Fifth, an operational and treasury playbook. Procurement, treasury, and legal need a simple rubric for deciding premium versus self-insurance. I recommend 3 financial KPIs for the board. Insured exposure ratio, what percentage of modeled tail exposure is covered by insurance or escrow. Claim latency, average time from incident to payment. And premium as percent of TCO, how insurance costs compare to total cost of ownership for the product. Treasury will ask, is the premium cheaper than expected tail volatility? Procurement will ask, does an insurance-backed warranty reduce our vendor risk enough to justify higher unit costs? Legal will ask, are our subrogation and audit clauses enforceable? Build a one-page decision matrix. Low exposure, low impact equals retain. Mid-exposure, high reputational risk, explore parametrics or escrow. High exposure, high financial consequence, pursue layered solutions. Primary parametric for fast liquidity, plus excess liability for catastrophic tail. Also decide accounting treatment up front. Is the premium an operating expense or a capitalized protection cost? Make warranties and premiums visible in procurement approvals so budget owners can see the trade-offs.
Sixth, a 30-90-day pilot blueprint you can run with minimal drama. Pick a single product line with clear telemetry and a manageable customer base, ideally something with existing SLOs and a clean data lineage. Phase 1, 0 to 30 days, inventory exposures, quantify loss bands, and prepare an underwriting packet with historical telemetry, incident postmortems, and proof artifacts. Phase 2, 30 to 60 days, run insurer market calls, share the packet, surface acceptable triggers, and capture pricing indications. At this stage, get legal to draft modular warranty language aligned to the proposed triggers. Phase 3, 60 to 90 days, negotiate a pilot agreement with one insurer or reinsure, define the parametric trigger in contract, and set up an escrow or bond if needed. Prepare a board briefing at day 90 with 3 items: the insured exposure ratio, premium as percent of TCO, and a recommended roll or expand plan. The goal is not to insure everything immediately.
The goal is to learn how insurers think about your telemetry and to build internal discipline around evidence collection.
7th, claims readiness and governance. Most claims fail because evidence is missing or timelines are missed. Design a claims playbook, immediate notification gates, a dedicated incident evidence pack with time-stamped logs and model snapshots, and a pre-agreed adjudication path with insurers. Run a simulated claim rehearsal once during the pilot. Legal, procurement, engineering, and your insurer should attempt to validate a mock trigger using only the artifacts you would actually produce in production. That rehearsal will surface gaps, missing telemetry, unclear chain of custody, or ambiguous SLO definitions before real money is on the line. Establish a quarterly review cadence with insurers. Review near misses, changes to models, and concentration metrics. Treat insurers as partners in resilience. The more transparent you are, the better the market signals you'll receive.
To wrap up, 3 executive actions you can take this week. 1. Pick one product line and assemble an underwriting packet, loss bands, telemetry, and incident history. 2. Run at least 2 insurer market sounding calls to learn acceptable triggers and early pricing signals. 3. Get legal to draft modular warranty language tied to objective SLO triggers and escrow mechanics. If you do those 3 things, you'll convert vague anxiety into measurable optionality, and you'll hand the board a fundable plan rather than a list of unknowns. Remember, risk transfer is not an escape hatch. It's a financial instrument you use deliberately to preserve strategic optionality.
If you want the checklist and the exact templates I mentioned, underwriting packet items, suggested KPIs, and starter warranty language, download the AI Risk Transfer Checklist at datascience.show/AI Insurance. I put this together for executives who need to act quickly without becoming technocrats. Subscribe to the show for more board-ready frameworks. When you translate risk into priced instruments, you move from worry to control. That's the difference between models and value.
Thanks for listening to datascience.show. If you found value in this episode, subscribe, share it with your network, and join us next time as we explore how data science drives smarter decisions and better business outcomes.